Please take your seats. The program is about to begin.
This is a Bloomberg Money Minute. We'll see whether Wall Street can get back on track after stocks took a hit in Friday's trading. Losses.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Citigroup moves $4 trillion a day. $5 trillion. It's larger than the GDP of France.
Wall Street used to be a place. Now it's more of an idea.
I love all these new Wall Streets. Y'all Street, Wall Street South.
I think it's everything in South Florida from Coral Gables to Jupiter, and there's finance all along the way.
It's one of the very few places that has no pretense of intellectualism. None.
It's kind of like a rat race. Everyone is running around trying to meet each other. It's like speed dating for hedge funds.
The power of being underestimated, it's a massive advantage.
There's no shortage of drama on Wall Street.
Please welcome to the stage Sonali Basak, anchor and global finance correspondent for Bloomberg.
Welcome back. I hope you all enjoyed lunch and got to meet many of your peers, and I'm hoping you enjoyed the video. That was the first time we've shown it in public, actually. So we'll be looking forward to your feedback. We just announced our new show, Bullish. Today will be out in May. We have so much more in store for you this afternoon, and in case you haven't done so yet, would love you to scan this QR code. It'll bring you everything you need for the event. You can find the agenda here. When you download the event app, you can follow our sessions and take part in the digital networking. You can schedule meetings with the people in the room today. And of course, you can find the Wi-Fi information. You're going to need that. This is also an area where you can submit questions to our speakers on stage. We will do our best to get to them. They will pop up on a monitor for us up here. And so we will look to you to see what you're thinking. There's also more information on how to subscribe to Bloomberg.com and discounts that you could take advantage of, because we have one of the best global newsrooms and finance and coverage around. But hey, I'm biased. You could also just ask the other 2,700 journalists we have around the world, though I think they'll tell you too. And lastly, if you're active on social, you can use hashtag BloombergInvest for coverage. You can also follow us on @BloombergLive on all the major platforms. And I would also like to take a moment here to acknowledge our 2025 Bloomberg Invest Advisory Board members, many of which have been gracing our stages throughout the day, but they've also shared their time, their insights, industry perspective, and they've helped shape many of the conversations that you're hearing across the 2 days. And those advisory board members include TCW CEO Katie Koch, Goldman Sachs' Mina Flynn, Ray McGuire of Lazard, Stephen Meyer, and Ann Walsh of Guggenheim Partners. I thank you all very much. And another great activation we have at Invest this year, Bloomberg Lab for Desktop. It's a new way to analyze data that's on the terminal, and it enables users to access Bloomberg data in a programmatic environment. And you can get a live demo of it in action and enter the draw to win an iPad. The Bloomberg Lab booth is in the gallery next to the registration. You can make your way down the hall at some point and check that out. Now, speaking of innovation, for more to what expect around artificial intelligence, very excited to bring my colleague Matthew Miller on the stage with Gary Cohn. He's the vice chairman of IBM.
All right, thanks very much. I'm very excited to welcome Gary Cohn here to the stage and to interview a fellow Ohioan.
Yeah, go Buckeyes.
Go Buckeyes, for sure. National champions this year. I can't believe we did it after that loss heartbreaking loss to Michigan. So I'm really fascinated. I anchor this show every day with Shonali and with Katie, and obviously AI has been really at the center of what we talk about. And lately, I live up in Westchester. I've been meeting a lot more people who work in machine learning at IBM. I didn't really know it was such a focus, but of course I remember IBM winning on Jeopardy, and so it does make sense in hindsight. You're now vice chairman after you spent obviously a long time at Goldman Sachs, then a little bit of time in the White House, and now you've been investing in tech until you moved it into the vice chairman role at IBM. You've known about AI, I think, for longer than many of us have. How are you working on it at IBM?
Well, thank you for having me. Thanks for the kind words. As you pointed out, at IBM, we have been involved in AI, machine learning, you can go back and call it if you want, for over 50 years. The AI that was used to win at Jeopardy or beat Kasparov at chess was a little different than the AI we have right now. During that period of time, you had to pre-program a huge database with all of the answers because we didn't have the real-time connectivity to the data around the world. Today, if you were going to play Jeopardy, you would completely do it differently. You would just allow the AI machine to go get the answer instantaneously. 40 years ago, you had to sort of put the answers in a room and hope that Jeopardy asked the questions in the categories you wanted. It was easier to program all the chess moves. Today, AI has evolved dramatically, and I think we're all living through this, I would say, evolution. I'm not sure it's a revolution, evolution of AI. We've gone from the concept, and if you look at sort of CEO surveys or corporate surveys, a year or two ago, I think it was about 90% of CEOs said they, clearly were going to be involved and use AI. And of those 90%, less than 10% could actually tell you what they were going to use it for. They just felt like they needed to talk about using it. Today, I think the amount of CEOs that are using AI continues to grow, but more importantly, they actually know what they're going to use it for. And the definitional outcomes of where AI can enhance your business is becoming clearer. That's where they are today. I think it's going to continue to evolve to where you can use AI in your business and where the paybacks are and how you create real productivity growth. I won't geek out on productivity growth, but at the end of the day, if you want to grow GDP and you want to grow your economy, it is all about getting more productivity, getting more units of work out of your labor force.
So I think about this a lot in a competitive sense. If you're a big business and you haven't figured out how you're going to use AI yet, are you too late? Have you lost out?
You're never too late. You're never too late. What you may be late is you may be at a competitive disadvantage to your nearest competitor, because they may be able to do certain things more efficiently than you, but you can catch up quickly. So you're not that far behind. So you have to sort of figure out where the opportunities are in your business, and it depends on size, scope, scale of your business. So like a very obvious place where in a bigger company, and this is something we did at IBM and we've talked about it, we like being client zero for all of our products. We did something relatively simple. It sounds simple, but it was not that simple. An HR chatbot. You think of what most people use HR for after the day one hiring experience. 90% of what they want is, they go buy an apartment, they go rent an apartment, they need a reference letter. What day did I start working? How long have I worked here? What was my last year's compensation? What was my bonus? And you want that sent like that minute. In a year or two ago, you used to call someone in HR, you used to give them the information, you used to tell them where you want it sent, and you hope and pray they sent it out quickly. Today, you're at IBM, you would type it into a HR chatbot, and the minute you said hit send, the letter will go out. So people are actually very happy. Oh my God, I get what I want. I get all this information. You have information about your benefit, information about your healthcare. We do it all real time. We cut 600 people out of our HR department. Now, we didn't fire them. We redeployed them to places where they can be more useful. And our satisfaction scores for our employees using HR has gone up dramatically because they get real-time answers. So it depends what you're trying to achieve in your company. There's a lot of people using AI today in code assist, in writing new code. So if you're in a big code writing shop or writing new code is important to you, and you're at a disadvantage because your competitors are using a code assist program and you're not, you're at a competitive disadvantage. You take a lot of people here in the financial services industry. Most banks happen to know what banks do. Most banks historically built a technology infrastructure on a sort of as-needed basis. And if you go pull back the covers, they've got lots of different systems in a variety of different languages. And when you try and integrate them and have them talk to each other, it's very difficult. So every bank during the course of the last decade or 20 years tried to think, how do I get all of my software? How do I get all my systems on a common language? It was an arduous task that was cost prohibitive. Today, it's not cost prohibitive. Today, you can get a code assist bot to basically port one language over to another language, and it's pretty flawless in how it happens. So there's a lot of places evolving today where AI is very useful, and it depends on your particular circumstance.
I want to ask you about the cost, because I think the reason it was so daunting in my mind, especially for a information technology company, is I was looking at OpenAI and thinking, you've got to invest $100 billion to create a large language model, and only a few of these giant hyperscalers in Silicon Valley can do it. Now, obviously, DeepSeek, although there are questions about how exactly they did it, how much it costs, shows that you can do it for far less.
Well, thank you to the Chinese DeepSeek for proving out what a lot of us knew in this country, but no one wanted to listen to. So if you look at what we've been doing at IBM, you look at what Meta's been doing, you look at what a lot of companies here in the United States have been doing, we've been building small models. What we have found, and DeepSeek sort of proved this out, the small models are much more efficient, they compute faster, they take less power, but they're not a model that can do everything. They're sort of targeted models. So the things that I was talking to you about, we have small models that are used for specific targeted goals. I think that is the future. We think that is the future of AI. We think most companies will engage with as many small models as they need to get done what they need to get done where they're using AI, and it will be vastly more efficient, vastly more cost effective for them. And I think this is the future where we're going. Look, will there be some large language models out there that are effective? Yes, but they will sort of be the catch-all models for everything.
So it still costs a lot of money to invest. I think Moody's estimated it's going to be $2 billion in investment over the next 5 years, which doesn't seem that far off when I look at the CapEx plans of these Mag 7 companies. You and I both lived through the internet bubble and watched so many companies put money into laying down fiber cable and build the infrastructure, the data centers of Web 1.0, for a lot of CapEx when they weren't getting a lot of return on investment, at least not for years, if they ever did. Do you see real parallels here?
Yeah. Yes. Look, as you're building technological infrastructure and backbone, you're building it based on what's available today and what you know today. The whole AI backbone, infrastructure, compute, technology, it's moving very fast. But you can't wait for version 2.0 or version 3.0 or version 4.0. You have to build based on what's available today. What's available today will be obsolete, a lot of it before it gets built, and it will get replaced by newer and newer versions. So there is a bunch of money being spent today that will have very low returns to no returns. But if you don't start investing, you'll never start. So you sort of have this prisoner's dilemma that I have to start building this data center, and I think I'm going to be putting XYZ chip in, but by the way it gets built in 2 years, I most likely will not be putting that chip in. And the amount of power I think I need to run that data center may be dramatically less because the next chip, I bet, is going to be a lot more efficient than the chip we have today. So a lot of this build, you can't wait for the efficient frontier because someone's always going to be out there. You have to keep building, and there will be a lot of waste to get there. I just think it's inevitable. And then, these AI models themselves are going to build upon themselves, and they're going to get smarter and smarter, and they're going to optimize and re-optimize, and everything's going to get better and faster and quicker. And ultimately, the AI of the data center is going to tell you how to build a better data center, how to build better connectivity, how to optimize the optimization.
What do you do, though, as an investor? I mean, as an IBM or as a Microsoft, or as you point out, they don't have any choice. They've got to build now. But what do you do as a private investor? What do you do as someone who's looking at markets? How do you analyze that?
Well, it's interesting. If you look at the history, and the history of technology is not that old. And if you look at, sort of what's going on here, ultimately, the bigger companies are going to have a real big impact in this. Now, it's really, and then I'll point out that all the bigger companies that we talk about today, whether it be the Metas or the Googles, I remember when Facebook started and it was a really small company. And I'm not that old. I'm old enough, but I'm not that old. So all these big companies, I remind people, start out as really small companies. So there are a bunch of small companies today that are going to be really big companies unless in that path, one of these bigger companies can buy them out. We've now got companies that can go spend $100 billion and buy out a company, relatively easily today. So if you were looking at what you think is the most likely path, I think the most likely path is the big, I don't know if it's the Mag 7, but the bigger companies who are spending the most in CapEx are the most likely winners. And they will, many of them will fund some of these startups. And almost all of the big companies have huge venture arms because they're trying to spend money in these startups. They're trying to get opportunities to let creative people create. And then as those products become really valuable, they're just going to buy them and merge them into the bigger companies. So, I guess my investment advice is, look, you can own some of these small companies, and most of them are private, and they're probably interesting to own a portfolio of them. But if you ask me where I think this is going to be a decade from now, I think the bigger companies are going to dominate the space.
Is that part of what you're doing at IBM? I mean, do you help Arvind Krishna maybe zone in on some targets?
We definitely have a ventures portfolio. We're always looking for something that's on the cutting edge that fits within our parameters, whether it's hybrid cloud, open AI, quantum, but we're very much in the open source, so we're going to buy open source companies. If it fits within our parameters and we think it's got an interesting opportunity, it's in our shareholders' best interest for us to get involved in the company early, not late.
By the way, a little bit detached from the specific AI conversation, what do you think about the M&A landscape right now? When we came into this year, me and Shonali and Katie were joking about an opinion writer who said maybe there won't be that many deals because everybody said this is going to be the year, that the regulators drop their guard and everybody can get together. Now it's starting to look like that may not be the case.
Well, that was the total market euphoria from November election to January 20th, was deregulation, ease of doing business. The FTC, the CFTC, the SEC, everything C is going to get easier and be much more pro-business. And we're going to have, this huge influx, this huge massive explosion of deals, of M&A deals, of IPO deals. Look, we're 45 or 46 days into this. I don't want to judge this book by its cover, but the first 45 days, we've not had an explosion of deals. In fact, probably based on what's going on in markets right now, market multiples, we've probably lost deals. So I would say the calendar from January 20 to today is smaller than it was. That's not a regulatory statement, that's a valuation statement. And you also have to be reminded that some of these commissioners are not in place, heads of SEC. Even the FTC doesn't have a full Republican slate. It's got 2 Republicans, 2 Democrats, so it's hard to get things through on a 2-2. These things take more time. So I think some of that euphoria is still there, but I think more people are taking the approach of, okay, you're going to have to show me it's a different environment than just trust me. I think we've gone from trust me to show me.
I want to get back to regulation in a minute as it pertains to AI, but you mentioned productivity. You don't want to geek out on it. We haven't seen much of an impact yet from AI on productivity. I actually have chatbot now open next to my Bloomberg screens every morning.
Does it make you more productive?
I'm actually getting a lot more detail into my newscast than I would otherwise. I use it as more of a glorified search, but we haven't really seen it boost the numbers economically. And I wonder when you think we're going to see that, and if it's going to actually have an effect on jobs. You mentioned that you've moved HR people out because you can replace them in that role with AI. Yep. Are we going to see, an uptick in or a loss in non-farm payrolls because of it?
So we've also created, artificial workers. So we now can create artificial workers in certain way. In our consulting business, we now have artificial workers who, will work 24-hour days, which is kind of nice.
Just like Doge.
Yeah. So I don't know if I'm going to make that. You made that comparison. I will not own that comparison. So let's talk about your question. I think your question is, if AI is going to be successful, are we going to see a real impact to labor and employment numbers around the world, let alone in the United States?
Yeah.
So my pretty bold answer is, and I always say this to rooms full of people like this, who usually first question I get is, isn't this devastating to the economy? I say, look, I'll give you the rest of the time I'm up here, which is very short at this point, so it's not a lot of time. I'll give you the rest of the time I'm up here to come up with a major technological advancement that destroyed jobs. And you can go back and you can take anyone you want. And so let's just take the internal combustion engine. That was supposed to destroy jobs because all those people that cleaned stalls and put shoes on horses, they were gonna all lose their jobs. Well, but all of a sudden the next day when we started putting internal combustion engines on the streets, we needed mechanics, we needed gas stations, we needed different skill sets, different people. But all of a sudden, there were more jobs created because people could go, 50 miles a day or 100 miles a day versus 2 miles a day. So their landscape, their business model expanded. It's no different than when the internet, I worked at a bank before we had email. We used to have, every floor had it. It had a person that printed the memos and put it in your mailbox and told you what time the meeting was or told you what time to go. What happened to that person who delivered the mail on the floor and printed the memos? They sort of disappeared overnight. Now, we didn't have less people. In fact, every bank, I guarantee you, since the invention of email, is double its size. Why? Because we got more productive. We got email coverage, so we could cover more clients. We could cover more people around the world. We could communicate quicker. We could communicate faster. I think AI is the next leg in this evolution of making us more productive. So look, will there be a change in skill sets? Yes. Will people do jobs that they hate? No. The machine can input data. The machine can take codes out of an operating room in a hospital and input them into the insurance reimbursement system. By the way, that job in a couple of hospitals has 40, 50% turnover rates because people hate doing that. They shouldn't do it. Those people in that hospital can now do a job where they try and work on recoveries and the hospital gets paid back. So I think you will see this natural evolution of people out of jobs that they don't like, jobs with low dissatisfaction ratings, to jobs that have higher satisfaction ratings that are more productive and grows the economy. That's the history of every other technological advancement we've seen. It's not overnight. That's why I call this an evolution, not a revolution.
All right.
And all this, by the way, and we probably won't have time, but remember, AI, I believe, is just a stepping stone to the real outcome, which is quantum.
Which is, I'm guessing you also think 10 to 15 years off.
No.
Sooner?
Sooner.
And how soon?
5 years. The strides that is being made in quantum right now are large. I mean, there's a lot more. Look, again, there's a lot of private capital going into quantum. It's big companies and small companies. It's all about error correction, how quickly you can correct error, how quickly you can compute. The data is pretty interesting right now. So, as we evolve, everything in this technology space is speeding up. So, 5 years.
All right, fascinating. I wanted to ask about regulation because you mentioned AI is going to help us create better AI, and I wonder what else AI is going to decide to do for us. Or do we need to regulate it? Do we need to have a heavy hand here, or is it okay to have a few South African billionaires just say, go?
I don't know what you're talking about. Yeah. I'll go to ChatGPT and ask what that is. So look, the answer is yes. And I sit on a couple of these big regulatory boards around the world. So I'll do this relatively quickly. If it's a regulated activity today, if you use AI, it should be a regulated activity using AI. So an example of that is if I'm going to call my doctor and tell my doctor that I got a scratchy throat, a headache, a swelling of this, and he or she puts it in a machine, and they're going to diagnose my disease and prescribe me medicine, That's a highly regulated business today. The AI machine that does that and the program that does should be highly regulated. On the flip side, if when I'm working out tomorrow morning, Spotify chooses a bad song for me and I have to hit skip, which they do a lot, I'm not sure that needs to be a regulated activity. I can get through my workout in the morning listening to one bad song or skipping a bad song. So my view is, look, we've decided what businesses are regulated. We know what business should not be regulated. We should not use AI as a wedge to regulate more businesses. On the flip side, we shouldn't use AI to take businesses today that deserve regulation and take them out of regulation.
All right, we have one audience question here on tariffs.
It's amazing how you got an audience question on your card.
Does this strategy make sense to you as a way to deter illegal immigration and fentanyl smuggling from Canada? No, seriously. We've seen for a couple days in a row, markets really come down. We've seen rates come down from 480 to 420. President Trump has put 25% tariffs on our two closest trading partners after he negotiated possibly the greatest trade deal in history with them, right?
Yeah, USMCA.
Does it make sense to you? I mean, you were there.
So, look, I think what we have to understand, and I'm not saying I understand this, but I think what we have to try and figure out is what is the objective of the tariffs? And that, to me, I think that's where a lot of us are struggling. Is the tariffs meant to make foreign products more expensive so the domestic product is cheaper? Okay, that's a good use of a tariff. The problem is a lot of the things that we import, we actually don't make here in the United States. So you can make the foreign product more expensive. It doesn't make the domestic product cheaper because we don't have it. So that's a question I have. But if we put that tariff on, does that incentivize CapEx to build the capability to make that product? You could argue, okay, that's not a bad long-term outcome because, look, if we took nothing else away from COVID, we should have taken away from COVID, there are some strategic needs of this country that we are just too dependent on the rest of the world for, and we better figure out how to be more self-sufficient on necessity goods and items. So, when it's coming to buying personal protective equipment and we have to import it from China and we need sterile gloves and masks from China, probably something we should manufacture in the United States. If we're worried about, toys and games, we can live without them. I don't think it's a necessity item. So I think we have to figure out what the objective is. If the objective is to raise money for the government, make that the objective. I'm not sure how you do that. And how do you do that with weighing the effects of inflation on the other side? And I think you have to think about that. So if we're just using it as a revenue raiser, it creates a higher cost of goods. It's a really regressive way to raise revenue because I hate to say it, the reality of it is poor people or less highly paid people consume 100% of their paychecks. Wealthier people consume a very small percentage of their paychecks, and they have to consume their paychecks. So the things that are being tariffed are things that everyday people buy, and it becomes a really regressive tax system. I don't think we want a regressive tax system. I'm the first guy here that's going to argue for a progressive tax system. The rich people need to pay more in this country. They should pay more, and they do pay more today. I don't think we want to flip that around through tariffs. So to me, the question is, what is the objective here? There may be a real robust, bona fide reason to have tariffs. I just don't know what we're trying to achieve.
And you would know, I feel like. Anyway, this is a thoughtful answer, and I appreciate your time.
Thank you. Thank you.
Thanks so much.
Please welcome to the stage Ryan McCormick, Senior Factor and Core Equity Strategist at Invesco, for a conversation with Bloomberg's Eric Balchunas.
All right. Thank you.
Thanks, man.
Thank you very much.
So,
Wasn't so bad, right?
the Qs. Just want to start. How many people own the Qs? Oh, you could sell some people here, Ryan. Okay. We are going to basically highlight the Qs. Okay, so I just want to start, and explain the NASDAQ 100. I work on a team with ETF analysts. We nerd out on all kinds of issues. We are just so fascinated by this index and the ETF, obviously, that tracks it. It's a weird index. We kind of call it the eighth wonder of the world. It captures the US stock market in a special way. Do you know that it's doubled the performance of the S&P 500 since it launched in '99? I mean, and the S&P is a really good index, right? So what's going on here? I want to really explore what is happening inside this index and why it's sort of become, doesn't get as much flows as SPY and the other ETFs, but it's close. And I just think it's an interesting ETF. Obviously, the performance has to make it pretty easy to market this ETF, right?
It does.
I mean, yeah.
I mean, it's the 5th largest in the world. It's the 2nd most actively traded. I mean, they're pretty robust derivatives market around it, whether that be QQQ, some of our other NASDAQ 100 strategies, or just the index in and of itself, right? A lot of derivatives that are tied to it. So there's just a lot of notoriety, and the fact that it's been around for 26 years, like a lot of people have crossed its path. So.
Ready for another fun fact? Actually, I'll turn this into a trivia question. You guys are financial nerds. Maybe somebody here, this is a tough one. This is like Jeopardy level 1000, okay? In the past 15 years, only one active fund has beaten the Qs out of thousands. I mean, we did a study. My colleague David Cohn did it. Only one person. Can anybody name the fund or the person? I'll take either. Yeah. Yes, Barron. This guy, Ron Barron. Okay, do you know how he beat it? Yeah, his fund's 50% Tesla, okay? Which is kind of, it's not legal to just put 50%, but he got it small and just let it run. And so the only thing you could do to have beaten the Qs was just buy a ton of Tesla. That's how hard it was to beat. What is the NASDAQ 100? I mean, it's not really beta. It's not totally tech. What's going on? Like, how would you describe it?
You're right, but I wouldn't go as far to say that it's like a factor ETF, right? I mean, it's beta-like. It's comprised of the 100 largest companies that are listed on the NASDAQ exchange, ex-financials. So what you wind up getting is this sort of like growth leaning, just when you're looking at the sector breakdown. You know, you're getting some tech names in there, you're getting some discretionary, some telecom, but you have these sort of like, of course, Mag 7, these kind of growth-oriented leaders of the past 10, 15, 20, 25 years that have all gravitated to this exchange and then by extension this index. So it's this sort of like growth leaning product that is beta-like is probably the best way that I can describe it, because there really isn't anything like it out there in the market.
Okay, can I give you my theory?
Yeah,
okay.
shoot.
This is just a theory. I think this index really started, it's similar to Nike and Michael Jordan. Steve Jobs decided to list there in 1980 when he was like 25 years old. I mean, NASDAQ was not that big. He went there instead of the New York Stock Exchange where IBM was listed, probably because he wanted to be different than IBM. And I just think people who are creators and founders and visionaries, they really love Steve Jobs, similar to the way basketball players would like Michael Jordan. And he kind of, you know, Michael Jordan went to Nike when it was the third sneaker after Adidas and Converse. And I find a parallel there. Steve Jobs chose it, and then when Steve Jobs Part 2 came in the 2000s, game over. Every single, it was like it became cool to go there if you're in this sort of tech visionary world. Is that, what do you think of my theory?
I think you're spot on, right? Yeah, Steve Jobs was probably the first. I mean, you can make the argument that Intel in the 70s, but I don't think Intel was as cool as Steve Jobs, right? Like he was kind of a tech rebel. And then I think as success started to come to companies like Microsoft and Apple and Intel, like you started to see the early 2000s, which you referenced, right? You started to see the Amazons in the late 90s. You started to see the then Googles, now Alphabets, the NVIDIAs long before it was NVIDIA, the Teslas. And it's almost like, you know, a snowball effect where if I'm an up and coming kind of like tech or technologically oriented CEO, right? And it's, hey, you could be listing where Apple and Alphabet and Amazon do, or you can go somewhere else and, you know, be sort of like a large cap value, almost like a stodgy feel. I think most of them would say, wow, like I could be in the same kind of realm of Apple and Amazon. I want to go that way. And, you know, I think we've seen that kind of perpetuate. I mean, the NASDAQ has won more listings than the New York Stock Exchange now for, you know, I think it's 40 plus quarters.
Wow.
So, they continue to sort of attract that sort of that sort of company. And I think it was all based on the fact that it was the first electronic exchange, and Steve Jobs said, all right, this is where I'm going.
Yeah, I'm trying to find the person who fielded that call. I've been digging hard. If anybody knows, let me know. I think it would make a great little mini documentary for my podcast. But anyway, I digress. So one interesting thing is research and development. When we think about these tech-oriented companies, a lot of what I think, we just talked about this recently with Steve Howe in our index group about research and development here versus other regions. It's so strong in the United States, and that is somewhat of our secret sauce. Yeah. Can you talk about the amount of R&D and patents that are embedded in the index?
Yeah, it's pervasive, and like from our perspective, right? Like this is one of our few funds at Invesco that isn't necessarily like factor driven or smart beta, right? So it is, I don't want to say purely passive, but it has a passive feel to it. So it's almost, we need to like reverse engineer the story where it's, okay, well, what has made this very small subset in terms of number of companies so successful? And so, the notion of innovation, the ability to change, and you look at kind of what companies have had the staying power over the past 25 years. And a common thread that we found was the fact that they spend more on R&D than their peers. In our last observation period, on a weighted average basis, I think it was 15.6 billion. S&P x NASDAQ 100, it was 1.5 billion. So an order of magnitude of 10x. And then, as a percentage of sales, over 11% of sales reinvested back in R&D. So like that's a very long-term and significant commitment that these companies are making. And then you kind of take it a step further, you peel the onion back one more layer, and we start analyzing patents across all these different disruptive technologies. And again, this like rather small subset, small in number, 100 companies, file a staggering percentage of patents globally for things like cloud, of course, cybersecurity, but things like speech recognition, image recognition, NLP. I mean, the last observation period, it was over 45% of every patent that related to NLP was filed by NASDAQ 100 constituents. So I think like the IP has become such an important part of not only the index, but under the hood, almost every individual company's growth strategy, that it's always front of mind for them, and that's become sort of a hallmark of them for the past, 1-2 decades. So it's something that is in their in the front of their minds. And I was just on a panel with some of these companies out at Consumer Electronics Show, and each one of them was 25% or more of revenue reinvested back in through R&D. All talking about human capital, attracting top talent. And again, it's one of those things where it sort of feeds itself. They are able to solve these kind of complex client problems, and in doing so, they develop and start to retain IP.
And one of the things people will say, well, it's all Mag 7. I mean, I think it's all close to half of the index now is Mag 7, maybe 42%, something like that. S&P also getting full of Mag 7, but this journalist Sam Rowe on X one time pointed something out that just changed my way to view this, which is that these Mag 7 companies are like 4 or 5 what could be other companies inside of them, right? They all own a lot. And I think if you look at them as the Mag 35 or the Mag 40, it makes you a little less paranoid about, we've got this concentration risk. Thoughts?
Yeah, I mean, I think these companies have spent a lot of time, money, and effort to diversify their business lines. I mean, you can make an argument that a lot of these companies could fit in multiple sector boxes. So without a doubt, I think like diversifying the revenue streams and basically the underlying components that make up the whole, I think that does help to address the concentration issue a little bit.
And we have only in 30 seconds, just give me one stock that isn't one of the more famous ones that has stuck out to you in the past couple months that is interesting.
Yeah, I mean, I think performance-wise, it would be a company like Netflix. I mean, Starbucks was interesting, with their turnaround and their new CEO. But I mean, something that people wouldn't expect would probably be something like IDEX Labs. So a mainly veterinary company. I mean, I don't think most people hear QQQ and they think, oh, I'm going to look at healthcare, but names like IDEX or Intuitive Surgical, there's a couple of biotech names in there as well. I mean, there is some exposure to healthcare, and I think people learning that IDEX Labs is in the NASDAQ 100 would probably raise a couple of eyebrows.
That's a good one. I didn't know that. All right, well, we're up. Our time is up, and I want to thank Ryan here for a great conversation. Thank you.
Thanks so much, Eric. Appreciate it.
We will need to start a process at some point to bring interest rates back to more normal levels.
Please welcome to the stage John C. Williams, President and CEO of the Federal Reserve Bank of New York, for a conversation with Bloomberg's Michael McKee.
Well, we'd like to thank John Williams for joining us today. He is, as you know, the president of the New York Federal Reserve, and your best bet for moving the markets today, if we can get him to say something that would do that, which I know you're going to work against me on that one, right? John, we got to start with I guess you'd call it the orange elephant in the room, the tariffs that the president put on today. For a long time, you've been saying to me, it's too early to know the effect of the tariffs. Well, now we've got some details on the tariffs. Your reaction?
Right. And I think the reason I was saying to you it's too early is because it really matters. It matters, which goods or where tariffs are applying, what countries, how long they apply for. So there's, when you look at the research that looks at the effects of tariffs on the U.S. economy, one of the things that's highlighted, it depends whether it's consumer goods, it depends on whether it's goods that lots of countries produce, and a lot of things like that. So, it really made sense to let's wait and see, find out more about what policies may be put in place, and then kind of, come to, I would say, conditional judgments about what does it mean for the U.S. economy. And as you said, we are seeing more actual actions on tariffs in different dimensions. I would still highlight there's a lot of uncertainty. We don't know how long the tariffs will apply. We don't know what other countries may do in response to this. We also don't know what else may happen in this, in the kind of realm of trade policy. My own view is that, based on experience from previous episodes, based on analysis, is that tariffs on consumer goods, especially, they do feed into import prices pretty strongly. That does filter in to prices that consumers pay. That happens relatively soon. Tariffs that feed into kind of intermediate inputs, the things that companies use to make other things and to make other things, those tend to pass through more gradually and have maybe last a little bit longer in terms of their effects. My view is that, based on what we know today, given all the uncertainties around that, I do factor in some effects of tariffs now on inflation, on prices, because I think we will see some of those effects later this year. Not yet, but maybe later this year. I also, you have to factor in how does that affect economic activity, decisions by businesses to invest, consumers to spend. And that's where I think another big uncertainty is. We've seen some kind of movements in the data in the last couple of months. I think some of that's in anticipation of tariffs, so it's hard to really read the tea leaves there. But that's something else we'll be watching carefully, is to what extent is that affecting consumer confidence, business confidence, the uncertainty around this and the effects of the tariffs economic growth and employment and things like that. So still a lot of uncertainty. I think directionally, somewhat higher prices in the outlook, at least in my kind of thinking about what's happening, but also a lot of uncertainty about how the economy responds to this.
The 2018 playbook for the tariffs in Trump 1.0, basically outlined by the staff in the Teal book that year, suggested that you basically had two options. You could raise interest rates to fight inflation, risk recession, or you could look through, ignore the tariffs, assuming that they would be a one-time rise in the price level, but not an ongoing cause of inflation. What do you think this year? Which of those two playbooks should you follow?
Well, you're going to get a little frustrated because I'm going to answer the same way I answered the last question, Mike, and that is it depends on how these, what goods, the tariffs apply to which countries, how long they're in place for, how big they are. So it'll depend on a lot of factors about how big the effects are and maybe how long these effects will last. I do go back to the broader context of monetary policy. It's not just about tariffs or trade policy. There's a lot of factors that influence the U.S. economic outlook and the global economic outlook. You have to take all of those into consideration, look at the totality of the data, look at the risks and uncertainties and what that means for achieving our maximum employment and price stability goals. So from my perspective, if you go back to the 2018 kind of briefing we got, clearly you want to think about how long-lasting these are, how big the effects are. But I would just reinforce this point. There's a lot of uncertainty about that, and we need to be guided not only by our economic analysis, by our absolutely fantastic staff who does all this work, but also what are we seeing in the data? What are we hearing from business leaders? What are we seeing in out there in the economy? And then from that information, kind of get a feel for which direction the economy is going, both in terms of inflation and employment. I mean, the good news here is the U.S. economy is starting in a very good place. Unemployment is 4%. The labor market is stabilized after cooling from red-hot conditions a couple years ago. Inflation is 2.5%, and it's been gradually coming down towards our 2% goal. So we're starting with the economy in a good place, and I would argue we're starting with the monetary policy in a good place, ready in a good position to adjust as needed, depending on how the data and the outlook and the risks of the outlook evolve.
Well, given the uncertainty you talk about and the time span before we might see things show up, is it fair to say that it's too early to consider changing interest rates at the March meeting?
Well, in my view, I think we need, I think monetary policy is in a very good place. It is, modestly restrictive. It is helping keep the economy, I think, in good balance. I expect the economy to continue to grow this year, roughly in line with, the economy's potential. I expect inflation would, over time, move down back to our 2% goal. So I think monetary policy has got the right, kind of balance right now. It makes sense to collect, some more information, not only about what's happening with trade policy, but obviously there's also what we're seeing in terms of other policies and fiscal policy and regulatory policy. So getting that whole picture, and then watch what's happening here in our country, but around the world, and put all of those together to see where monetary policy, what the appropriate stance of policy will be. But to answer your question, I think the current place where policy is good. I don't see any need to change it right away.
All right, there you go. There's one market moving headline. You mentioned what information you're trying to collect from the companies that you speak to. Are the CEOs as lost as the Fed and the rest of us in terms of what the impact of all this is going to be?
Well, I think when you talk to business leaders, the first thing that they tell you is they have to prepare for whatever happens. They're not sitting there having to guess, well, this is what will happen or that will happen, but really think through strategically about how to manage, different scenarios and how to behave. And I think one thing you're getting more of a sense of from some business leaders is kind of a view of, let's be cautious about making big business decisions right now. Let's get that additional information around what's happening in terms of this broad set of policies before making decisions. I mean, measures of uncertainty are pretty high right now, and I think people are taking that into account as they think about, maybe collect that more additional information before they make those decisions.
Well, as they try to put these things together, what's their underlying view of the economy and what they would do, and then how is this laid on top of it?
Well, my view coming into this, setting aside, say, some of the trade policy issues that we're talking about, is the economy is very strong, very solid growth. We've had very good productivity growth. We have a solid labor market, and the economy is in good balance, and inflation is coming down. So I think that's your starting place. And then the question is, what happens with various policies, and how does that, kind of what adjustments do you have to make in your thinking relative to that? But I firmly believe that we're starting the year not only in where we are today, but the momentum we have is good growth this year, slower growth than say last year, but inflationary pressures coming down. Now, of course, you have to add to that any policy changes that affects that.
Well, that's the big question. What are companies telling you about their plans for dealing with tariffs? Are they going to pass them through?
Well, I think, again, it depends on which industry you're talking about. It depends on, some tariffs may apply to some industries or goods and not to others. I mean, right now, I don't hear people literally saying, here's how it works. I do go back to the experience of 2018 that you talked about, 2019. And also some of the experience of the pandemic. I mean, when producers or retailers are confronted with much higher costs, they have to figure out what to do, and they're going to try to pass that on to their customers as much as they can. They're going to try to find probably some ways to adjust other margins of cost or prices, and other competitors and things may take actions as well. So I think there's no kind of plan that every business has for that, but based on history, what we've seen is, we see a pretty high pass-through of tariffs at least into import prices.
Well, in 2018, you were looking up at the 2% inflation target, and companies had no pricing power, and we were all very excited to go online and shop and get very big discounts. That all changed after the COVID pandemic. So does that set us up in a different way to deal with rising prices? Are companies going to say, hey, we did it, now we can do it again?
Well, I do think that you're absolutely right. The conditions back then where inflation had underrun our target, moderately for about a decade. We were looking for inflation to get a little bit higher on a sustained basis at 2%, and the economy was strong. The unemployment rate was low in 2018, 2019, so we're in a very good economy. And the actual policy actions that happened, both on fiscal policy and trade policy, I mean, they clearly affected the economy. We saw, I think, some boost to inflation, short-term boost to inflation, but it was in the context of economy that was, hadn't seen inflation for a long time. The experience of the past few years has shown that businesses have become much more attuned to how to figure out how to pass on cost increases. They feel they have more pricing power. They've flexed that pricing power quite a bit during the times of shortage. And I think households also very sensitive to prices, a high cost of many goods. So I think it is a different situation today. And you see this in surveys and other forum. We talk to people. It is different than it was in 2018, where really there was almost a decade of no inflation. So I think it's a different context.
Well, speaking of surveys, recent surveys that have come out show people think inflation is going up, even at the longer term. The Michigan numbers for 5 to 10 years are up. Are you worried that Americans are going to be much quicker to sort of de-anchor their inflation expectations?
Well, it's obviously something I watch very closely. Inflation expectations, whether in surveys or from market measures or from economists, are something that's really important for us to study, to understand where the people are thinking about inflation, how they view future inflation, and that feeds back into the economy. So it's a really important topic. I can't help but point out that the New York Fed, we carry out our own survey of households, a survey of consumer expectations, and study every month the results from that survey. So it's something I take seriously. So what am I seeing in terms of the surveys? I think on the Michigan survey, clearly it's, the most recent readings have moved up quite a bit. That's something to watch closely. I'm not going to say it's not important. I do think that there are some aspects of the Michigan survey that might make it a bit sensitive to some spikes and things. We've seen that in the past. particularly kind of how they ask the question, how they collect the data. There's nothing wrong with it. It's just that we've seen that sometimes you'll get a big movement that gets reversed. In our survey of consumer expectations that we've done, at least for the data we have, which is not the most recent data, we haven't seen much of a movement in short or longer run inflation expectations, but it's something I'll be watching closely. One thing that definitely happens, and I think we're hearing from businesses, and I think we are getting this from, some of the survey data, like in the Michigan survey, is the talk of tariffs, the sense that there's higher prices out there is clearly influencing how people are thinking about inflation this year. I'm not seeing as much of an indication in most of these surveys that that's about long-run inflation or inflation in the future, but more about inflation in the near term. And clearly, people are experiencing some higher prices and are maybe more focused on that right now.
You have to come up with your own survey answers at the March 19th meeting. In December, when you put out the last summary of economic projections, it was widely assumed that was sort of a dead letter when you put it out because nobody knew what Trump was going to do, and by March, you'd have a much better idea. Do you have any better idea, or is this also going to be something we'll look at and go, we'll see you in June?
Well, if you look at my website, I have this thing about research interest, and it says monetary policy under uncertainty. And I think that's a good description of my job, because you always have uncertainty. You have uncertainty about policies. We went through the pandemic. We've gone through various events over the past several decades. So you're always dealing with that uncertainty and needing to make the best decisions. I do think relative to December, clearly some of the actions that have happened, even the discussions in Congress around fiscal policy have provided a better idea of the types of policies that we will or likely see. I still think that I don't have a lot of confidence in, say, the base case, that this is my forecast for the economy, this is where it's going. I'm much more in the kind of the mode of thinking there's a bunch of scenarios that could happen. We could see this happen, the tariffs be very short-lived, and then we move forward. Where there's others where it's much more permanent or different. And so it's really thinking through these scenarios, thinking through what the risks those imply for achieving our maximum employment price stability goals, and then how do we position policy for that. So it's not about getting the right guess about where everything's going to happen, but it's really just getting policy position right. So that's how I'm thinking about it. So do I have more information that helps inform that? Yes. But it's still, I think that the base case I would, or the one that we're asked about is kind of the most likely scenario, is not the only one that's important. You really have to think through all the different paths that we could be on.
Well, along with the summary of economic projections comes everybody's favorite diagram from the Fed, the dot plot. In December, you said 2 this year. The consensus median was 2 rate cuts this year. As of today, we've priced in 3 in the futures markets. Do you think 2 is still a baseline, or do you really have no idea at this point?
So Mike, my whole attempt to say I'm not putting a lot of weight on my base case didn't work at all, right? So I try it again. No, I'm kidding. I think it's really hard to know. I mean, right now the markets, as you say, they're pricing in 3 to 4 rate cuts this year based on futures. If you look at the modal expectation in the market based on options, it looks maybe more like 1 or a little bit more than 1 cut this year. And again, these are market expectations. I'm not making a prediction. I think that's actually really kind of informative. Market participants are trying to figure out, well, the modal case is something like 1 cut or maybe a little bit more, but there's just a wide dispersion of views out there. And it gets back to these scenarios. If you're in the market, you have to think about what are the different scenarios and position for that. Clearly, market participants are kind of thinking about some scenarios where they're protecting against scenarios where the Fed needs to cut some more than the base case. And I think what that's just reminding us is just there's a lot of uncertainty about the economy, about the policies. I'm always just focused on one thing, which is how can we set policy and hopefully set a path of policy that best achieves our goals. We're starting in a good place. Let's just try to keep the economy on the right track to get the inflation down to 2% over the next couple of years and keep the sustain the strength in the economy and the labor market.
I want to switch over to the balance sheet because there's still a lot of interest in it. There are projections basically you're going to stop QT roughly the middle of this year. But there's also a paragraph in the last minutes that suggests that you might stop it early if the debt ceiling is not resolved, because that could affect liquidity. Is that a real possibility?
Well, let me explain that notion. I mean, right now, our strategy hasn't changed. The strategy is we want to continue to reduce our holdings of Treasury and mortgage-backed securities until we get the level of reserves to what we say is somewhat above ample. And that's something we study very carefully. We have a lot of information from market participants. We have various statistical and other analysis we do to try to measure are we providing enough reserves into the banking system to achieve our interest rate control goals. So that is a strategy we put in place a couple years ago. We're still executing on that. One of the things about that strategy is we need to be monitoring what's happening in money markets, what's happening in the repo markets, the Fed funds markets, what's happening, in all these different indicators we're looking at. And with the debt ceiling dynamics that we're talking about here is that during a period of the debt ceiling, what happens is basically the Treasury spends out a lot of their money that they hold in account at the Fed. That actually increases reserves. As the debt ceiling is ended, that switches. And so you get big movements in the amount of reserves out there. There's really not driven by the demand by banks or the financial system, but kind of artificially moved around by kind of the dynamics resulting from a debt ceiling issue. And so the point that we're really making is we want to have a good view of what's happening in the money markets, in what's happening in kind of in general in there. And this is, in a way, making it harder to see what's happening because these other movements driven by the debt ceiling dynamics are kind of clouding that picture. So the idea of either pausing or slowing the shrinking of the balance sheet temporarily was really just to make sure that we're, during a period where we don't see things as well, that we don't inadvertently get to a place where reserves are lower than we intend. So it isn't a change in the strategy. It isn't a change in kind of what we're trying to do, but it's really about how do we best execute on that strategy in a way that achieves the shrinkage of the balance sheet without any market disruption.
All right, we're getting a little low on time, so I'm going to shorten my questions. We'll do something of a lightning round here. We know the Fed defends its independence as important for good monetary policy. Are you worried about Fed independence over the next 4 years?
I'm not worried about Fed independence. I am obviously, feel that Fed independence or independence of central banks in general is extremely important. We carry out our decisions, our analysis. Everything we do is to achieve the goals that that we've been given by Congress of maximum employment and price stability. We're just, everybody who works in the Fed is just committed to achieving those goals as best we can. It's not in any way influenced by partisan or political influences. I think the evidence internationally is having an independent central bank gives you better outcomes for the economy, for the people of the country. So it's not like I like independence because it feels good or it's comfortable. It's because it's been shown to yield better results in terms of inflation and economic results. And that's why I think it's really important.
You've started your review of the monetary policy framework. What is it you're expecting to find or do? There's been criticism of the Fed letting the economy run hot for too long. Do you need to get back to perhaps anticipatory rate moves to keep inflation in check?
Well, obviously we are in the process of reviewing our framework, and that will be a very thorough discussion of a lot of lessons learned. So I won't comment on that. I do think one important thing was with the previous framework, which was instituted in 2020, was heavily influenced by the basically decade of very low inflation, interest rates near zero for 7 years, and a very unusual environment, and designed to address some of those issues. But at the same time, it was designed to be able to set us up for success if the opposite happened, if we had high inflation or too. So although a lot of the attention on the 2020 framework was about the changes we made then, from 2012 through today, our framework has always emphasized the importance of achieving 2% inflation price stability, always emphasized the importance of well-anchored inflation expectations. And I think just it has always been founded on this notion that price stability is essential for economic prosperity. So that's always been there. That's not going to change. And I think, and again, I'll just say, there was never any confusion about that, or in any way did our framework interfere with us making the decisions we need to make sure that we ultimately restore price stability.
Let me tie it all together in one last question because we're basically out of time. But given what's happening on the fiscal side and in Washington, given your review and given where we are in the economy, are we looking at a regime shift in the U.S. economy, one that would lead to changes in the way you think about or perform monetary policy?
Well, I think the U.S. economy is amazingly dynamic. I know that's a theme here. We are the leaders in innovation. We are the leaders of dynamism in the global economy. So you're always operating in a changing environment. Fiscal policy is part of that. Other policies are part of that change. But in my 30 years in the Fed, I've been through many different cycles of fundamental changes in our economy. When I started out, we didn't have the internet. We didn't have a lot of things we take for granted. But I think, from my point of view, we always need to be open to the fact that parts of the economy, parts of the global economy are changing. And again, how do we take that into account, do our best to understand what that means for achieving our goals and make the right decisions? So are we seeing changes in fiscal policy or trade policy? Yes, but in the broader context, I would say my whole career has been a time of various changes, and we just have to be good at adapting to a changing environment and carrying out our mission.
John Williams, thank you very much for joining us today.
Please welcome to the stage Ryan Tolkin, CEO and Chief Investment Officer of Schonfeld, and Jim Zelter, President of Apollo Global Management, for a conversation with Bloomberg's Shonali Bassick.
Thank you both for joining.
Happy to be here.
So it's interesting, the perspective both of you are going to bring, because we have the private market perspective, we have the multi-strategy hedge fund perspective. Everyone knows what this week in the market looks like. It's pretty brutal, to say the least. Ryan, how have you been navigating what's going on? How are you looking at the most recent moves, the most recent volatilities in the broader scheme of things?
Thanks for having me. Let's take a step back. We're 40 days into a new administration, and I think a lot of what we've seen is probably what many of us expected, but what the markets failed to price. And so over the last 40 days, we've seen a pickup in that base level of volatility. Uncertainty has clearly risen. We're clearly seeing a consumer that is a bit worried. We're seeing retail sales lower, University of Michigan confidence numbers lower. We're starting to see uncertainty in the corporate boardroom. And I think that's starting to price into equity markets as well as fixed income markets. We've seen the 10-year rally from what was 480 to now 415. We've seen equity markets sell off 5% plus from the highs. We've seen a correction in the Mega 7. And so we're starting to see some of that uncertainty that's getting priced in through a combination of economic uncertainty and geopolitical uncertainty in the markets. And so for us, what we're trying to focus on in the end of the day is which ones of our strategies are ultimately in a position to benefit from that. How do we set up our portfolio such that we are leaning into the strategies that are more positively convex, that benefit more when the market ranges increase, that benefit more when ultimately the correlation factor of stocks is greater than where it was over the last 12 to 15 months. And that's really what we're starting to see.
Jim, that interest rate part of the equation has been really interesting to see that drop off from 480, as you said, to 415. Stunning move since the middle of January. What is your tariff takeaway at the end of the day? When you look at the market, it seems to be screaming growth scare.
Yeah, I think that, I look at this as really an intersection of, when we came into the year, a lot of, tremendous animal spirits on taking risk on in virtually every asset class. And now we're at a collision between macro paralysis. And so when you talk to folks that are inside boardrooms about strategic M&A, about IPOs and other large capital formation activities, there's just really a standstill right now. And certainly in the short term, the conversation about stagflation with the tariffs and other activities and tax cuts, that's got to be a short-term conversation. But, as Ryan said, heightened volatility, access to some companies are sometimes in question. Those are periods when we as a franchise and the world of private capital, private credit, we welcome these opportunities because
There's always great companies that need to get financed. But certainly you have a white-hot marketplace that has been punched in the face the last 5 to 6 days about the reality of not 1 or 2 initiatives out of the White House, but a dozen initiatives and 70 executive notes in the first 32 days. So it's an extreme time that many of, or if not all of us, have never been through before.
To that end, Schonfeld has actually held up well against its peers in this environment. It's been brutal. A lot of people, as you say, Jim, have definitely felt punched in the face by this market. What's working in this market?
Sure. So as I said before, I think some of the strategies that we deploy that tend to benefit as the ranges of individual stocks expand is what's working. So for us, we've got a big quantitative trading business. When market volatility and market volumes increase, as we sometimes see in these periods of uncertainty, that can be a really beneficial market for some of our quant trading strategies. Some of our short-term trading strategies that can take advantage of some of the momentum or the reversal of momentum in some of the stocks that ultimately probably got to valuations that were too high based off of some of the animal spirits that Jim mentioned. Leaning in and deploying more risk in those type of strategies has certainly worked, as well as some of our volatility strategies that ultimately benefit from the breakdown in the correlation regime that we've seen over the last 15 months. And so those are the things we're leaning into. Of course, some of the strategies that are short vol, that in the end of the day are more momentum oriented, that outperformed, in the post-election period up until Inauguration Day. Those are the areas and those are the parts of the portfolio that are struggling. And so trying to figure out as investors how we square some of our risk in those areas and make sure that we're set up for the uncertainty that's likely to continue going forward. I mean, if what we've seen over the last 40 days is any indication of what we're going to see over the next 4 years, we need to be prepared for consistent tweets, consistent executive action and things of that nature. And so as such, it's really important that we start to reposition some of our portfolios.
It's interesting. And Jim, I have to give you credit because doing this conversation with the two of you was your idea. And I first asked what you both had in common, and it's the Duke endowment, interestingly enough. So you're not only watching this market from the perspective of your own firms, you're also watching it from the perspective of a large institutional investor. A lot of soul searching going on in this market right now. You mentioned animal spirits. Apollo talks a lot about market concentration in particular. What do you think the new truths are going to be about this market as people realize being so overweight, just a small handful of names is maybe not the path forward?
Well, I think there's a lot of questions there. I think we've been very vocal that the evolution of the marketplace, the evolution was gone in the area of credit, which certainly we feel we're front and center in, and Ryan can talk about his franchise. But if you look at the role that we play today in capital formation of companies, and there's a couple of big misnomers. Private credit is not just the non-investment grade sponsor lending. That's an interesting asset class. We're a big player. It's a $2 trillion asset class. We've been very vocal that the opportunity set is much bigger in the 40 trillion asset class. And I do think that right now, what the backdrop that Ryan described is we've had a very concentrated market, tech-led, and there's a greater degree of dispersion of company outcomes. That's good for real investors. If you're a real money investor, I think that's a way for you to outperform instead of being involved in a passive index or a concentration. So from our perspective, this is the kind of environments that we like, that we expect. There's still a tremendous amount with all the initiatives that have been announced, there's a tremendous amount of capital needs from a variety of investment grade companies. And we're poised to be able to participate and provide that capital. But I will say, base rates right now, low fours, mid fours, high fours, when you can look at where you can be a lender in the world of credit around in the US today and in some parts of Western Europe, it's a very, very provocative asset class in terms of the appeal of the duration of that coupon, the compounding, and when you lay that against what's going on right now in the world of equity with volatility. But the basis of my conversation for leading us here is that people really don't think of a multi-strategy firm like Schonfeld and Apollo having a lot in common. But I think if you see what's going on in the asset classes over 25, 30 years, there's a reason why we both ended up in these situations.
To that end, what are you seeing in terms of the ability to kind of dive in as investors start to spread out? General commentary here. I mean, what do you make of the fact that investors were so long NVIDIA and maybe nothing else?
Yeah, I think that's where the opportunity is. And so to the extent that we see the breadth of the market expand, that's really good for our business. Ultimately, we benefit from dispersion, as Jim was saying. And so our job is to identify relative value opportunities across a combination of the asset classes we trade. Sometimes they're more in the equity space, and we can take advantage of that. Other times, we've built out businesses like our macro fixed income business because there are more opportunities there. And so what we're trying to understand across all the asset classes we trade is where is the risk premia mispriced relative to the volatility and the liquidity that exists within that asset class. And when we see meaningful dislocations, which we've started to see, and which if this uncertainty continues, I expect us to see in an even greater magnitude, we're poised to take advantage of that. And by having experts across a combination of credit and vol, long short equity, quant, and each of the different strategies we run within our multi-strat organization, we have the insights, we have the analytics to be able to compare where that risk premia is mispriced and how we can ultimately lean into it. And I think that's what we're trying to do. And to the extent that volatility increases, I think you see more of that mispricing.
Jim, it'd be a missed opportunity if I didn't ask you if your thoughts were changing about your broader view of the world here. You have a lot of investors starting to think about stagflation, maybe even a recession, complex situations around sticky inflation, but slowing growth. How do you navigate what's your base case here?
Well, I mean, you know, Torsten really is our spokesman for the economy. We still think the underlying economy is quite strong. There's a bunch of curveballs with regard to the Doge activities and government, you know, cutbacks of 300,000 people and the multiplier on that. But, you know, I think all the things that Ryan's been talking about, whether it's volatility, you know, in the marketplace, concentration, that brings a conversation to investors to a firm like ours where people are saying, you know, there's a pension deficit. They want to allocate more to private capital, private credit, because the simplicity of compounding and getting a coupon every year. And so in periods like this, we always find ourselves busier than usual. There will be a period where the public markets have a dislocation. There may not be perfect access for many companies. And so for us, like this is the reason we were built for these types of markets, to be robust, to be in business, to hang our shingle 24/7, and such that when companies either facing an M&A opportunity, a strategic purchase, whatever it may be, that we're open for business and can write $5, $10, $15 billion commitments across the debt and equity you know, vertical and horizon. That's what's important to us.
And I want to go back to what you said about base rates still being elevated. You mentioned your fixed income business too. I presume it's part of the same reason. You have base rates elevated. How attractive is the fixed income opportunity to you right now? And would you ever consider privates?
Sure. So for us, we focus a lot on liquidity. And the reason we focus on liquidity is ultimately it allows us to pivot as market conditions change. And so we have stayed away from the private credit space. Jim's the expert in the private credit space, but we've built a credit business. We've built a fixed income business to trade across a variety of the more liquid and tradable, you know, credit asset classes. And that's been beneficial for us in that, you know, when the opportunity is in investment grade credit, we'll be there. When that opportunity shifts to high yield, we can be there. When that opportunity is in Europe, we'll be there from a geographical perspective. And so we think there's enough to do in the more liquid credit markets that's consistent with our conviction and belief in having liquidity and being able to pivot, especially as market volatility increases. And so for us, I think that's the name of the game.
You know, I think the idea of liquidity brings me to, I think one of the most interesting stories for structure in private credit, the ETF that was just put out by State Street that involves Apollo. You have a trading desk now, Jim, also that looks to trade private investment grade debt. What's the grand plan here? How liquid can these markets get at the end of the day? Apollo talks so much about the convergence, but what's the timeline and what's the scale?
Well, again, let's take a step back. Why we're both up here today, I think that when you look at the evolution, I've been doing this is my 39th year in the industry, and when you look at where the credit markets were, the role of, you know, the old Goldman Sachs, the old Bear Stearns, the old Merrill Lynch, and then the consolidation of global banks, it's not a surprise post the GFC that you've got some very large platforms, ours being one of them, and the same parallels happened in the multi-strategy. Back in the early 90s, it was all about single manager hedge funds, and it was a star system. That still may exist today, but not to the same degree. So the breadth of capital, changing our liability, we have long tail liabilities, taking our cost of capital from 20% down to 6%, and being able to bring in the best and the brightest from the sell side. It's changed the complete dynamic of our business. So when you ask what's the end game, having done this for a while, there was a period of time in the early 90s where loans did not trade. Believe me, in 1990, no one traded a loan. Now it's a $2.5 trillion asset class that has plenty of ETFs and trades very actively. Last couple of years, the CLO liability market, AAAs, they were used in the past, they were bought by 7 banks within 3 blocks of the train station in Tokyo. Now there's a $22 billion ETF on CLO AAAs. And so what we're trying to do, I can't directly address it with what you asked, but the reality is there's an evolution into a lot of these asset classes. Our focus is on the investment grade part, not the old traditional leverage lending part. And as more investors come in that are focused on transparency, on information, and on financing those assets, there will be a marketplace for those.
I know you're begging for this question, right? When you think about all the activity that's moving outside of the banking system to you, does that pose a new systemic type of risk?
We've been very clear the US banking system is the healthiest in the world, and the fact that over the last 25 or 30 years that the banks have systematically dispersed risk by the syndicated loan market, by a massive investment grade bond market, by a securitization system that really, whether it's synthetic risk transfer or other trades, there's a reason why we're the healthiest market in the world. There's a reason why one of the largest, most growing economies in the world, or the largest and most robust economy, why private credit has succeeded here. So we would vociferously have the view that we have mitigated a tremendous amount of risk with less levered balance sheets and longer duration liabilities.
And just to add to that also, the fact that the banks are much more focused on market-making activity instead of the proprietary trading activity, and that proprietary trading activity has shifted to buy-side institutions, whether that be the Apollos of the world or the Schonfelds of the world. And so a lot of the types of trading businesses that we run today are trading businesses that existed inside the banks that, in the end of the day, do take risk and do ultimately take the other side of certain transactions. And I think whether it be the index rebalance business that was very popular in the banks, in the 2010 to 2015 era, that's now much more popular on the buy side, or some of the Delta One businesses, or certainly some of the macro fixed income businesses that both Jim and I both run. I think these are all examples of things where that risk has shifted from the sell side to the buy side.
So when you look at them, yeah, go ahead, Jim.
And I would say, when you think about, I think from our perspective, we've partnered with the banks as strategic partners from origination, whether it was Citi or BNP or large financing arrangements with Standard Chartered. We've found a spot where either we're pari passu with a longer tenor, or we're senior junior, or whatever it may be. The same can be said certainly for the prime brokerage business and the securities lending business, where the largest institutions are focusing on the largest multi-strat funds. And there's a degree of dialogue and senior leverage that occurs across our organizations. And we both have seen the consolidation of resources and dialogue and flow, and want to make sure we position our firms collectively to be able to be the partner with the banks in those areas.
In the hedge fund world, the multi-strat world has gotten such a big role in the world of hedge funds more broadly. So what risk are you most worried about then? People talk about concentration, leverage, but what is it for you, Ryan?
Yeah, I mean, clearly the largest risk is ultimately crowding risk. And so, I think given the way in which some of the risk has transferred to the multi-strats and the multi-PM organizations, you have to focus and understand where people are positioned, where the crowd is. And so what do we do about that as an organization? we try to invest and we try to build businesses where there are larger barriers to entry, where it's not so easy to stand up and replicate a business like some of the things we do overnight. And so we touched on the quant business earlier. One of the reasons why, if you look at our risk allocation to the quant business as compared to many of our peers, we are more allocated to that business is there are a lot of barriers to entry. It is hard to stand up a quant business. The costs are high. The cost of acquiring talent is high. The cost of building and maintaining a data platform is high. The cost of investing in consistently upgrading execution infrastructure is high. We've been doing it for multiple decades as an organization. And so we have the benefit of not only the long-term investments we've made from a CapEx perspective, but also the recognition that we have a bunch of proprietary data that ultimately cannot be bought off the shelf. And so when some of our peers tell us that they're trying to build new quant businesses, we sit there and we say, good luck. It's really, really hard, and the barriers to entry are high. And so the way you protect yourself from the crowd to a large extent is you make sure that you have more risk allocated to some of these businesses where the barriers to entry are just higher.
And in our example, the comparison, again, to compare and contrast, we had a view that in many asset classes, the perception and the reality of investor is size is an enemy in many asset classes. In the world, the reason why we are so large in credit is scale is a massive advantage. We've taken our cost of capital down dramatically. And when Ryan talks about the quant business, you've heard me talk about it, Shonali, we are focused on the origination business. Many asset management firms are focused purely on raising capital as the competitive benchmark to success. We think it's all about your ability to originate proprietary deal flow. And so for us, we spent a decade, spent almost $9 billion, 16 origination platforms, 4,000 people that every day come on in and produce that safe, secured yield for us. So for us, we had a vision 15 years ago where the industry was going, and we wanted to build a machine that would really be able to take that on, ready for this prime time activity.
I keep making a joke that origination is the new hot job on Wall Street, but stick with that for a second. You have done something else that's been fairly new for Apollo's history, which is acquisitions. And you look around the industry, and in the private credit world in particular, just an enormous amount of consolidation. What's the strategy here?
Well, we've done a variety of smaller tuck-in acquisitions, and before I got to Apollo, I spent 20 years on the sell side at Goldman and Citi, and having been through a few acquisitions, they're culturally challenging. Embedding a culture, an investment culture, a risk-taking culture with new people is always hard. So we've chosen to do very, very small, add them into our business, whether it was Gulfstream or other things that we've done, or Stone Tower in our credit business, or mid-cap. We've chosen to be very small, have them get up to speed in our business for a while, and then really scale it over time. So I do think just having a toolbox with lots of different brands in it and showing that to a borrower, I think that's a cumbersome toolbox. For us, we need to be really on the same page.
Look, and just to add on to it, in our space, I do think that throughout our history, looking at different acquisitions and thinking about how we grow through a combination of partnership, joint venture, or acquisition has all been a part of the Schonfeld story and the Schonfeld DNA. I think about how we ultimately stood up the Asia business, and we considered a bunch of different alternatives before we decided to expand into Asia. One was to try to start a business organically, but ultimately we chose the path to first form a joint venture with another asset management organization, and ultimately when we had the opportunity to then actually go out and acquire that business in Asia. And I think about that business, and to Jim's point, at first there was a lot of cultural challenges as it relates to the integration of the two businesses. It was roughly 50 people at the time in which we acquired that business. But today, that business is 225 people for us. It's roughly 25 to 30% of our risk. We made probably 30 to 35% of our P&L in 2024 out of the region, but it was ultimately sparked by some acquisition.
But would you be open to more in the future?
Yeah, of course. I think we've got a business development team out there that's roughly 30 people, and we're out there looking for different opportunities every day. Sometimes those opportunities just come from bringing some new talent, into the organization, and sometimes those opportunities come from acquiring new businesses. And so when I look across the suite of strategies we trade, certainly as it relates to expanding some of the existing strategies, there are acquisition opportunities that we're considering right now. When I think about expanding into new strategies, it's always easier to think about and look at if somebody's been there and done that before. And so when we built out our macro fixed income business, that was an acquisition opportunity. That was a business that was going to think about getting started as more of a single strategy fund, but recognized that there were economies of scale in ultimately bolting on that business to a broader platform that traded a variety of different investment strategies, where ultimately the data, the insights, the analytics that we have within the platform could be shared to create something better than what a single strategy fund does.
Before I let you go, would love for both of you to lean in, because both of you have talked about your people. There is a talent war going on that is very significant in both of your businesses. How do you win it?
Being Apollo. We have an amazing brand. No, we're very fortunate. We have, for every position that we post, there's a line over the transom of great applicants. It's not just been the last 6 months, it's been the last 15 years. And you don't grow like we've grown with great senior talent across many parts of our organization. And again, I think, Ryan talked about it. Whenever you want to do a new business, it's buy versus build. We find that when you go on your own, there's a tuition you have to pay. So a small acquisition that forces you at the edge to figure things out, we find that's the better way to go. But the human talent, we are in the ultimate human capital business. It's what drives us. Mark and I spend so much time talking about it and leading by example. So listen, by no means is it over. It's a constant marathon.
I'll say two things on the topic. One,
you can't steal the answer, so.
Great talent attracts great talent. And so if in the end of the day you put great talent in leadership seats, that's the number one path to victory. The other thing that we say at Schonfeld is ultimately talent development and talent retention ultimately is the tool toward talent acquisition. And so if we have great risk takers and ultimately we build great businesses with those risk takers, they become the greatest ambassadors for us recruiting future risk takers into the organization. And so that's how we've gone about trying to build our business at Schonfeld, which is have an industry-leading talent retention rate.
Thank you both so much. Very complicated market, but a lot of change in your businesses. We really appreciate you taking time with us today.
Thank you.
Thank you.
Please welcome to the stage Raj Dhanda, partner and global head of wealth management at Ares Management, and Mina Flynn, co-head of Global Private Wealth Management at Goldman Sachs, for a conversation with Bloomberg's Katie Greifeld.
All right. Hello, everyone. I'm Katie Greifeld. I'm joined now by Mina and Raj, and we're talking about the pulse of wealth management. We're going to take the pulse right now, and I think a nice scene setter would be to just talk about how you guys work together, how your two worlds intersect. Mina, you are the co-head of Global Private Wealth Management, also the co-head of One Goldman Sachs, and Raj, you're the global head of wealth management at Ares. So Mina, I'll start with you. How do you see your two worlds touching?
Sure. So we have the fortune with working with ultra high net worth individuals. And our portfolio construction has roughly about a 25% allocation to alternatives for those individuals. Within alternatives, one of the sub-asset classes is private credit. We spend a tremendous amount of time at Goldman diligencing managers. And we diligence them both on the investment side as well as on the operational and the risk side. And a handful of managers we do put on our platform for our clients then to be able to implement their alternative exposure through. And so we are fortunate to be partnering with Ares as it relates to our private credit allocation within alternatives.
And Katie, we have the benefit of partnering with really just a few global platforms like Goldman, and our mandate is to deliver the best of what Ares Management does globally. So whether it's solutions that fall under durable income or private equity or real assets, and whether it's education or portfolio construction, we partner with a few of the global wealth firms, and and bring our best strategies to them, and that's the relationship, and it's global and it's across all the markets.
Well, let's talk about what that looks like. What a wealth portfolio that includes private assets looks like. And Mina, you mentioned that you work with ultra high net worth individuals. So my first question would be, what is the current definition of ultra high net worth, and how do you think about what asset allocation looks like in those types of portfolios?
Sure. So ultra high net worth we define as $25 million over in investable assets. In terms of the allocations, as you would imagine, it's very bespoke and customized. But at a very high level, I would say if we've got a moderate risk individual, we would roughly have about 40% of their portfolio in public equities. We would have 25% in alternatives, and then we would have the remainder in high quality fixed income. The portfolio construction is just super important. It's the number one conversation that we have with clients, both upfront and then on an ongoing basis. And the reason why this is really important is that you want clients to be able to withstand the volatility when you've got markets such as we've got today and not be taking so much risk that they sell and crystallize a loss versus actually staying put or buying more. But on the flip side, you also want to take enough risk such that you offset inflation on an after-tax, after-spending basis, which is why it's that diversification of both high-quality fixed income, equities, and alternatives.
And you think about the past few weeks we've had, I'm sure there's plenty of investors who would prefer not to mark to market right now, but this brings me to a point that I think about a lot when I think about allocating to privates versus the public markets. And I realize it's not a black or white scenario, but there was a really interesting conversation that Eric Schatzker had with Dawn Fitzpatrick of Soros earlier today. And her view was that basically that private investors, those who've shifted from publics to privates, are in for a world of hurt, because up until the last few weeks, I mean, you could get 20% back-to-back gains in the S&P 500. And Raj, I wonder how you think about that from where you sit. What you're giving up in terms of liquidity and potentially returns when it comes to the private markets.
Yeah, of course. So the advisors we work with and their clients have actually been quite frustrated with the public markets over the last 3, 4, 5 years. And it's led to this real ramp in flows for firms like Ares. And it's very client driven. The public markets have become highly concentrated. So the 6 or 7 largest names represent 50% of the trading activity.
The magnificent ones.
The Mag 7. And you contrast that with the fact that 90% of companies with over 100 million in revenue are private. So you've had this sort of push and pull. Public markets are extremely volatile, concentrated, and as such lack diversity. And I say it somewhat in that it's ironic. 20 years ago, this wasn't the case. But today, private market solutions spans infrastructure, real estate, private credit, private equity. And that really enables you to rethink the investment landscape. I think of it as you would have a bucket of equity exposure, a bucket of credit, and an allocation of real assets. And in each case, you can have public and private allocations. So I don't know who's in a world of hurt, right? I mean, the volatility just since the new administration has been here has made it really difficult for advisors to keep their clients invested. And what we do is, and when we partner with the premier brands like Goldman and their advisors, it's quite easy because if day trading is one extreme and wealth creation is the other, we get to partner with advisors that think about portfolio construction across all these attachments, private and public.
Well, Mina, I'd love to hear your perspective on that. That obviously, again, it's not black and white, but how do you think about that, the different return and liquidity profiles?
Yeah, I think we've been investing in alternatives since the 1980s, and so our clients are very familiar with alternatives through multiple market and economic cycles. Just to pick up on what Raj said, I think one of the most important things about alternatives is that while they are illiquid, they actually put the emotional side of investing to the side because they don't mark to market on a daily basis. And so it actually helps clients stay invested
instead of getting really nervous and selling when you probably should be buying. And so, one is it puts the emotional side of investing aside. The other, also in terms of what Raj said, is if you look at the last 25 years, the number of public companies outstanding has decreased. And the number of private equity-backed companies and private markets has increased 6-fold. So the investable universe is much larger. And then the last thing I would say is because there is so much capital now in private markets, the ability for these companies to fund themselves in private companies and really transform their businesses and have a significant amount of value creation is there. And so these companies are skipping small, mid, large cap before they do go public or emanate or just stay private.
Yeah.
And so I do think that it's a very attractive asset class. But to the overall point also of how we started this, it is illiquid, right?
Yeah.
And so you really do have to be mindful as it relates to where do you put your capital before it gets called, as well as how much of that capital are you comfortable being in illiquid assets?
Yeah, I mean, those are some interesting points you made. And to your point that, we've seen the public markets, the investable universe of public equities that are out there, people, or companies rather, just skipping up and IPOing as large caps. The point has been made to me that that's why you would want to be in alts, that, you're missing out on all that growth. It's not necessarily happening out in public, but if you can get private market exposure, you can still actually participate in some of that.
Absolutely.
Yeah. So
actually, to that point, one of the things I would say is we actually did recently increase our allocation to growth and to buyout in alternatives, and we actually took it out of international equities. Still have exposure to international equities, some of the best companies in the world. But just again to your point a little bit, when you think about the innovation and value creation and growth, and then if you look at buyout and specifically more middle market or upper middle market, the amount of value creation that these managers can bring and help these companies through, and then they really also have multiple paths to exit. And so the operational excellence really help the company create more value, and then you have multiple paths. And so we recently actually took our allocations up to alternatives to take advantage of that.
And Raj, come in here because what we're talking about, obviously fundraising is one thing, and we were having this conversation in the green room that deployment is a totally different conversation. So as we just see private markets get hotter and hotter, it feels like the headlines just get even heavier each day. How are you viewing that from where you sit?
Well, so Ares has been around now almost 25 years, a little more than 25 years, and it sometimes is assumed that you can't keep innovating throughout that long a period, but sports is an interesting area that, as an asset class, it took a firm like Ares to develop the right solutions to owners of the different teams. And we think of the opportunity to invest in sports as a case where the solutions expanded the addressable market. And today, across leagues in the US, opportunities globally, it's a asset class that has come about really since the beginning, since just before COVID, and into a whole nother democratized opportunity. So that at a really simple level, we don't think of it as alternatives anymore. We think that term is a bit backwards. We think the public markets is a great alternative. And we think that the private markets allow you to do a lot of different, to access a lot of different opportunities that you can't actually do otherwise.
Yeah, well, I'm sure you guys have heard the idea that the public and private markets are converging. And you talk about financial innovation. I think we have to talk about the private credit ETF that launched last week from State Street and Apollo. Probably not the product for ultra high net worth individuals, but you think about the fact that this product even exists, the idea that you will put a liquid asset, such as the type that we're talking about, into an extremely liquid wrapper. I just wonder, what your high-level thoughts are.
Well, I mean, any sort of innovation in the product space or further democratizing these solutions, we applaud, and we think it's a step forward. But actually, today you can recreate a lot of that exposure. You can invest in a public BDC, you can put that together with public fixed income options and create that. So we'll see how that does evolve over time. What we're really focused on is, and I think this is where the sort of sweet spot of Mina's platform is too, is that investor that has between $1 million and $100 million, and their allocation, certainly $1 to $5 million, is still in the mid-single digits. Perhaps not on the Goldman platform is sophisticated enough, I'm sure it's more, but that's a $80 trillion addressable market. It grew last year to almost $100 trillion. And that's where we're spending a lot of time providing them the education and the portfolio construction advice to grow their private markets allocation.
Right. And Mina, I don't think that necessarily you're buying ETFs for your clients, but I am curious how you are actually getting exposure to the private markets, what that avenue actually looks like.
Yeah, I think one of the things that we think is really important when we are investing in private markets is that you take a 5 to 6 year approach to actually get invested. And so you want to take a vintaging where you're starting to build a portfolio over a full market and economic cycle. And that goes for your overall level of exposure, as well as the sub-asset classes within alternatives. And roughly when you get to 5 to 6 years, you start to get capital back, and then it starts self-funding itself. And so, I do think that one thing that's really important is just thinking about it from that landscape versus putting all of your money to work at once.
Right.
That being said, even for the ultra high net worth client, there are points that are attractive, whether it's an ETF, whether it's an open-ended fund or semi-liquid fund. And I'll give you an example. When you had private credit dislocate a couple years ago, if clients want exposure, they don't want to have some don't want that entire J curve in terms of waiting for capital to be put to work. And so that's a very attractive way to be able to gain exposure on a real-time basis.
Yeah.
And so we do see, as well as for some of the other accounts beyond the matriarch or patriarch.
Well, and some of this innovation that Mina's referring to has really only been around for 5-6 years, and it does allow individuals to allocate on their time horizon. So as we refer to them as semi-liquid offerings, one of the benefits, they're open-ended, so the client's own liquidity needs or opportunities drive their time horizon. And that's a really effective way to build a portfolio.
Somehow we only have 5 minutes left, and a topic that we spent a lot of time on the prep call talking about, and I know that we all want to get to, is this idea that there's going to be a wealth transfer, both when it comes to women, which is something we've talked about, but also when it comes to generations, this generational wealth transfer. And in these wealth management roles that you have, I wonder how much of your job is getting to know an entire family, not just one client, one decision maker, but really getting to know all the different generations?
So we have 1,000 advisors, and we work with 17,000 families. So you do the math, it's 17 clients or families per advisor.
I'm glad you did the math for me.
You get to know the family really well, and it's one of the things that we really charge our advisors with. And family members have different objectives, they have different risk tolerances, they have different lifespans, and so it's important to customize for actually each family member. To your question about the wealth transfer that's going on with women, it is a really interesting demographic shift, and effectively what's happening is that women tend to marry 2 years older. They tend to outlive men by 5 years. And so the first passing of money tends to go with the baby boomers from the patriarch to the matriarch. The second thing is that women are making more money. And the third thing is more are managing the money for their household. And so you're seeing women much more in the driver's seat now versus maybe what we would have seen 5-10 years ago. And, we're adapting to that.
Yeah. Yeah, and it's interesting, and Raj, I promise I'm going to get to you, but you think about Sally Krawcheck actually had a really thoughtful column a few months back. Of course, Sally Krawcheck of Ellevest, and without playing into stereotypes, she mentioned, one of the points she made was that women interact with their financial advisors in a different way. It's a different type of relationship, and that's something that I think about a lot.
Yeah, I would say that there's a few things that I would say as it relates to women as clients. One is that I think they actually tend to start the conversation with financial planning and then actually get towards the investment portfolio. So think about, what am I trying to accomplish? What do I want to provide for my kids, for my company, for my, for the community? What do those returns look like? How do I do that efficiently? And then actually plug in the investment side versus going with a perspective of, I'm looking for 8 to 10% returns. How do I do that?
Right.
And then I would say very focused on financial education, both for them and their family. And then the last thing I would say is that I think there's a misnomer out there that women are more risk averse than men. We don't find that, actually. We find that they're risk aware and they really want to do scenario analysis to be able to understand various scenarios in terms of how a portfolio would perform under different environments. But that is not something that we see. There's still a tremendous amount of interest in alternatives, in equities, et cetera.
Look, I think I have 3 children. I don't have the same math you do on touch points with women advisors, but I do think the next generation is much more interested in pre-IPO opportunities, whereas our generation thought about the IPO as where you get an entry point. And so, and I think they're also a bit weary of volatility, and so I think this massive wealth transfer is going to further broaden the private markets, and I think the next generation is going to be all about those opportunities.
I mean, and it brings us back to what we were talking about 15 minutes ago, that all of the excitement, a lot of the growth, it feels like, is in private companies. That's, I think about SpaceX, Stripe, et cetera. We have 10 seconds left, so I'm going to make the choice to end it here. Before we do go, I do have a script to read you on the topic of wealth management. Wanted to give you the chance to scan this QR code. I think it's right up there. That will allow you to unlock an exclusive preview of our latest Bloomberg Media Financial Advisor study. It delves into new insights regarding the mindset of financial advisors, current industry trends, and effective strategies for creating meaningful connections with them. So you can go ahead and scan that. I see a few people are. Mina, Raj, I so enjoyed this conversation. Thank you for joining us.
Thank you. Great to be with you.
Thank you, guys. All right.
Intelligence tool is going viral. It's called ChatGPT.
When ChatGPT came out, it really quickly gained traction. You might ask it, write a poem about unicorns, and it might spit out something that sounds just like it was written by someone. That really struck a chord with a lot of people. It also struck a chord with investors.
Tech companies and their investors have sunk billions of dollars into building AI systems with the bet that these tools will keep getting more sophisticated and one day prove wildly profitable.
There's this concept in AI that if you just sort of keep feeding an AI model more and more data, more and more compute power, that it will start to just sort of teach itself and become smarter and smarter.
But progress seems to be getting a little bit trickier for some of these big companies.
As expenses skyrocket, an industry known for moving fast and breaking stuff could be slowing down.
I think the progress is going to get harder. When I look at 25, the low-hanging fruit is gone.
They're trying to figure out, how do we make these models that are getting increasingly expensive, eating up increasing amounts of computing power, worth that trade-off, right? If you're not getting this incredible boost in performance, what do you do?
Please welcome to the stage Kathy Wood, founder, CEO, and Chief Investment Officer at ARK Investment Management, for a live recording of Odd Lots with Bloomberg's Tracy Alloway and Joe Weisenthal.
We're just going to get the mics placed real quickly. How are we looking? We good? Okay. Great.
All right, well, hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Just before we begin, a reminder, this is in fact a live recording of a podcast, so please make sure your phones are switched off. Please try not to make too much noise. You can laugh, you can, well, you can,
Boo.
no,
boo.
don't do that.
No, don't boo.
Don't do that. But please try to keep noise to a minimum. And so without further ado, we are going to start with our guest, Kathy Wood, founder and CEO of ARK Invest. Thank you so much for being here.
My pleasure, Tracy, and Joe, really happy to be here with you and with you.
So the big story in markets right now is a widespread sell-off in the past couple of days. But even before then, we saw something specifically focused on AI. And the worries seemed to come out of nowhere. Suddenly, everyone was talking about DeepSeek, this Chinese AI model, and we saw a really intense sell-off. Were you aware of DeepSeek before that day? And how big a problem do you think something like that is for US AI?
Actually, we were aware of DeepSeek R1. I think the paper came out in December. And so our analysts had pored over it and thought it was a very interesting model. I think the surprise and the question was around, wait a minute, did this take only $6 million to build this large language model? And did they really do it on a high-end workstation? Are we going to need all this data center capacity after all? And I think with time we've learned that they did a lot of pre-training before. Apparently, they have a 50,000 cluster of GPUs, which help with the pre-training. Nonetheless, as some of our finest technology experts, Sam Altman and Jensen Huang included, they commented they were terribly impressed by the algorithm itself. And I think what we were impressed by is it's open source. Anyone can use it. So here we go. Meta Platforms was really the open source platform, large language model. Now we have DeepSeek, and I think yesterday another one came out, Kung Fu.
Oh, I totally missed that one. I love trying the new ones. I'll try it tomorrow. Right now, we're recording this March 4th. You know, when the market sold off, there was this concern like, oh, will the greater efficiency mean at the margins less demand for chips or less impulse to build out data centers? And there's no like hard evidence of that, but there's the big tech companies, enormous CapEx budgets every single year, and they're throwing out these unbelievable numbers. There are hints here and there. Have you observed anything tangible, say over the last several weeks, that to you suggests that there is some change at the margin, DeepSeek aside, in how much businesses, hyperscalers, et cetera, are throwing at AI right now?
I have not seen any change in
There's no evidence of a slowdown.
The power of these models is profound. And if anything, we just had a conversation with one of the largest LLM. We're under an NDA, so I can't talk about which one, providers. And it's clear that nations, educational systems, and enterprises are all saying, we have got to do this. This is transformational in so many ways. Many are talking and thinking about productivity and efficiency. But others are thinking about deep research, especially with the new reasoning models, and deep research is one of them, and are just blown away by the results that we're getting. So I'm not seeing any slowdown at all.
So you mentioned the fact that DeepSeek is open source, and that was a big differentiator between it and some other models. I know you're a big fan of open source. How do you incorporate that aspect into, I guess, an investment analysis? And also, did OpenAI make a mistake by not going open source?
Well, we've been tracking closed models and open source for ever since the ChatGPT moment. And what you'll see is the closed models have been ahead of the open source models. But if you look at the slope of the line of the performance improvement, open source is actually a steeper slope. So the reason I love open source is it is helping along the competition, helping the movement along, helping it go faster. And I think that open source nipping at the heel of closed is a very good thing.
So, you know, ChatGPT came onto everybody's radar, I guess, late 2022. And I think objectively, anyone who spends any time with these tools, in a sense, is just absolutely jaw-dropping, right? Are you surprised, however, that we're like this far into it and the tools are so, in some sense, extraordinary, but we can talk about some of the flaws and limitations, and yet we really haven't seen much of a macro impact from their use. We haven't seen some sector of the economy or the labor force get laid off. We haven't seen some major surge in measured productivity gains, although that's infamously hard to measure. Are you surprised in any sense by the existence of the technology and what seems like sort of a modest macro impact?
So I do think productivity has been boosted to some extent, and you're right, it's very difficult to measure this. My background's economics, and in the 80s, productivity was a big question mark, and we saw how flawed the measurements are, and probably still are. So I can only tell you the rate of uptake is so much, is that enterprises are seeing a difference. Maybe if they're not laying people off, they're not hiring them. And we know that, and that's because these AI tools are making their own, especially engineers, so much more productive, right? So you just don't have to hire that next person. If you've seen the number of coding employees in the United States has dropped like a cliff. I mean, off a cliff. It hasn't dropped like a cliff, it's dropped off a cliff. And I don't know if you've seen that chart, so that very much has happened as engineers just become more and more productive. You know, one of the things that we're wondering is, okay, what part of the software stack will this, the traditional software stack, will this impact? And we think the AI revolution is what we see already losing share to some extent. It is still growing, but losing share is software as a service. And, you know, I think we're all paying very close attention to the revenue growth dynamics of these companies. A Salesforce.com, revenue growth isn't picking up. In fact, it continues to decelerate. I think it's next quarter will be, I think, 7% down from 9%. That's not what's supposed to happen here. And so I think that might be what you're referring to. Wait a minute, where are the top line dynamics? Where are they coming from? Well, I think we have a lot of entrepreneurs in a lot of garages or in R&D centers who are creating the next big thing. And you know, we look at two profound ramifications of AI that we understand. We've been researching them for so long. The largest AI project on Earth is robotaxis, autonomous driving networks. We think that's going to drive $8 to $10 trillion in revenue globally in the next 5 to 10 years, up from zero now. So that's called embodied AI. The most profound application of AI, we believe, is going to be in healthcare and the convergence of sequencing technologies, artificial intelligence, and new technologies like CRISPR gene editing are already curing diseases. Sickle cell disease and beta thalassemia cured. CRISPR Therapeutics has that cure. It is generating revenue now. People find this one very hard to believe because it hasn't happened before. But the R&D explosion in healthcare is like nothing I've ever seen. And we think we're going to return to the golden age for healthcare. I started in the 80s when Genentech had taken off and created the golden age for healthcare back then. Returns to R&D back then were in the 30% range. Today, for the broad-based pharma biotech field, the returns are down in the 4% range. we think with all of these new tools and the incredible productivity being added to research and discovery in the healthcare space, we're going back to the golden age where returns on R&D could be 30, 40% plus.
Shameless plug for the podcast here, but we have a really good episode coming out on biotech that walks through a bunch of the AI implications as well.
True.
But since you mentioned robo-taxis, we got to talk about Tesla.
Of course.
Obviously a big component of your portfolio. Elon Musk seems very busy nowadays, to put it mildly. As an investor, do you worry at all that he is perhaps distracted from ostensibly the day-to-day running of the company?
We've been getting this question practically since the beginning. So Tesla, and then he starts all these other companies, right? And people are saying, does that not concern you? So I'll answer that first, then we'll bring in the government overlay. The reason it doesn't concern us is Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies, really catalyzed by AI. And he understands that the name of the game in terms of who's going to win all this, through all of this, are those companies that, number one, have deep domain expertise. They take AI seriously and they're investing in it. And perhaps most important, they have data that no one else has, proprietary data. Think of all the data spewing out from all of these companies. Even Neuralink, that's biological data. And the most prolific data explosion out there is in the healthcare space. We have 37 trillion cells in our body, and they turn over every quarter. And now we have something called single cell sequencing that we can combine with AI to unlock the secrets of life, health, and death. And that's what we're going to do. He understands that. Neuralink's a part of this. Okay, overlay in the government sector. I agree, he's doing something certainly for his country. I know he believes that.
He's tweeting a lot, that's for sure.
He's what?
He's tweeting a lot.
He always has tweeted a lot, right? He always has tweeted a lot. Anyway, so he's, I think what we have found with his companies, and we own in our venture fund, the private ones, as well, of course, as Tesla. And as we go through the quarterly reports and dialogue with management, critical to us is that he is keeping his eye on the technology balls that are his competitive or barrier to entry. And what Elon is expert at doing is if there's a bottleneck, he'll go in there and blow it up. And he will use first principles thinking. And he's surrounded himself by business people and engineers who want to work on the hardest projects in the world, the hardest projects that are going to help transform the way we live and work and so forth. Doge is another big project. It's not his full-time job, even though one would not know that. But we have talked to our counterparts, and we aren't talking to Elon as much these days, but to other very important decision makers, and they're really not skipping a beat. Now, the politics of what's going on have hit sales. And so, yes, that is true. That is why, and we knew that was going to happen. So there are a couple of calls this year, actually probably 3. We knew Model Y was going to be completely refreshed, largest selling car in the world. That is beginning to happen throughout the world. And if the Model 3's refresh is any indication, this should work out very well. Perhaps more important is the lower cost car that they are going to put out in the first half of this year. So $30,000 or less. and think less, especially with different credits. This is going to open up Tesla to a whole new market. A lot, as Elon says, and people don't believe him in this political dynamic, but its problem isn't demand. There are people who have been waiting for a car, they just can't afford it. And they're very excited to have their first Tesla. So that's the second thing. The third thing, and we've watched this very closely, as you all know, autonomous. We do believe, well, they're launching in Austin in June, another important milestone. Now analysts have to integrate into their models what autonomous will mean for Tesla. And so anyone who's been viewing Tesla as an EV manufacturer is going to have to go back to the drawing board and realize that the gross margins of its autonomous network, its autonomous platform, will be in the 70 to 90% range, whereas their EV gross margins are in the mid-teens right now. That's a double take. This is turning into a software as a service model. And that finally, I think, will bring technology investors and analysts into this stock. They understand SaaS and how different the model is compared to an EV model. And the other thing about the AI opportunity in autonomous is it's winner take most. And we do believe that Tesla is in the pole position here in the United States. Anyone who's tried a Waymo car, as I have in both San Francisco,
big Waymo fans.
Big Waymo fans.
Big fans. If you look at Big Ideas 2025, which is our annual report, you will see why, and kudos to Waymo. I agree, it's a delightful ride. But in terms of the economics for Waymo, their car is uneconomic, totally uneconomic. It's going to be very difficult for them to scale without deciding to lose a lot of money.
Right.
And you'll find that delineated in Big Ideas 2025.
Since you mentioned the stock and the idea of like tech investors coming back, let's talk about tech stocks, because obviously they've gotten really hit hard over the last week. But overall, there was that furious post-election rally, sometime, with various peaks in things December. There's been this decline. What's going on? Is there a macro story behind the tech sell-off? When you look at how the market's behaved, what's your answer?
Well, I think, fear and greed is a constant trade-off, and I think after the election, the day after the election, the market started broadening out enormously away from just the Mag 6 towards our kind of stock. And the reasons for that include deregulation. Deregulation or regulation has been a menace for innovation generally, but even the FTC not allowing M&A and not allowing strategic price discovery to say, hey, this new innovation is going to be worth a lot and we need it.
Now the FTC is keeping the same merger guidelines.
Pardon?
The FTC is maintaining the merger guidelines. So we haven't seen this big M&A whip. Anyway,
I think we will see it. I think deregulation is critical to this administration's mandate. It feels it's one of the most important variables, because if you think about what was going on before, no M&A. Even if companies didn't compete directly with one another, they disallowed so much M&A that the big companies kind of could sit back, fat, dumb, and happy, and their shareholders didn't want them to buy anything because that would take away from their own whether it's share repurchases or profit or profit sharing and so forth. So. I think that this administration is going to provide a really beautiful runway from a regulatory point of view for innovation. And I feel that what is also behind this, as you might imagine, China with DeepSeek, as we were talking about, okay, they're on our tail, right? Well, the Trump administration is extremely competitive and has China in focus, shall we say? So this is a good news thing. So let's do this. The other reason I think the market took off, or there are many reasons, but I think tax rates coming down broadly, which I think they will, as an offset to some of the tariffs. And I understand tariffs. I don't like tariffs. Tariffs are taxes. But if you listen to Kevin Hassert, it seems there's a quid pro quo developing here where, wait a minute, in the early days of our country, all of government was funded by tariffs, all of it. And now very little of it. I think they might be into a little bit of a rebalancing game. And what the clue there is, in terms of tax rate reductions, what are the first ones they've announced? Tips, Social Security, and overtime. Those are very appealing to the lower to middle income demographic, right? I think lowering all tax rates is going to be much more acceptable with that kind of dynamic at work as well. He's looking out for the little guy like he said he would, right? And so I think as a student of Art Laffer, lowering tax rates, deregulation is, we think, it's going to recreate something like the Reagan Revolution, but I think it's going to be bigger. It's going to be bigger because there are 5 innovation platforms now, 14 different technologies, whereas back then it was the PC. It was the PC. Now we have 5: robotics, energy storage, AI, blockchain technology, multi-omic sequencing. 5 at the same time. They involve 15 different technologies, and they're converging. Autonomous taxi networks, convergence of robotics, energy storage, and AI. Those are each one of those has its own S-curve, and now they're going to be feeding one another. I mean, I think the Reagan Revolution, and I was there, and it was so enjoyable. It was the heyday, golden age of active equity management, and I think that's coming back. I think it's coming back big time. I think this will dwarf that, and that was pretty good.
I want to ask a sort of general question about your investing strategy. And I know you emphasize that you're making long-term bets on transformational technology like AI, which we've been discussing, or robo-taxis. I guess my question is, at some point, the promise of that world has to come to fruition and actually be monetized. Do you ever set yourself deadlines for positive returns, or is there a time frame you have in your mind for when this will pay off?
So our investment time horizon is 5 years. What's very important about the way we do our research, the most important variable in terms of determining how quickly these technologies are going to scale is units. Now, and something called Wright's Law. I don't know if you want me to go into it. It's a relative of Moore's Law. It's a way to understand how quickly the costs associated with each technology are falling. So we have had a good sense of all of these technologies' cost decline dynamics. What was one of the biggest things that happened over the last 5 years? Unit growth plunged during COVID. And then we faced all of these massive supply constraints. That hurt the rate of change for some of our technologies. We're on the other side of that. We are on the other side of that. In fact, we're on the other side of 3 major headwinds over the last 4 years that really hurt our strategy. First was the boom bust associated with COVID and all of the excesses around that. Second, interest rates, very importantly, a response. 24-fold increase in little more than a year's time. That was a major shock to the system. Now, do higher interest rates always hurt our strategy? Not at all. In fact, 2017 and 18, we had some of our best years, one in an up year, one in a down year for the market when we were up. Interest rates going up both years. I think we've just been through a very unusual circumstance. So we're done with the interest rate headwind. And we're done, if you think about it today, the long bond yield hit 4.12%. I don't know where it ended, but who expected that a few months ago? That's telegraphing something, and I'll get into that in just 1 minute. But interest rates, they're not going up. We do not believe they're going up. Second was the concentration in the market towards the Mag 6. And that really started after 08, 09, this desire for large cap, lots of cash, and yes, touches something sexy like AI, right? So that went into overdrive. We've never seen a more concentrated market in our history, not even the Great Depression, which was a binary, will this company survive or not back then. So to see the same kind of underlying fear and crowding into a few names tells me there's been a lot of fear out there. I think the first order impact of the election was, okay, some of that fear can dissipate. Now we have a whole new set of fears, but we can talk about that in a second. So we think that the market it has started and will continue to broaden out. This market, if it continued towards Mag 6, not a healthy market, just not. By definition, a broadening, two things happen after a major concentration, one of two things. Either a bear market, like tech and telecom bust, and early 70s, the end of the Nifty 50, or the other four major episodes of concentration, the other four major ones ended up in bull markets that broadened out. We think that has started. There will be to and fro's. Maybe the most important and surprising to many people of the headwinds, which we are no longer facing, is valuation. If you look at enterprise value to EBITDA, which is our chosen metric, so the entire cap structure divided by EBITDA, which is not subject to financial engineering, you'll see that our portfolio, and we worked with S&P, adjusting for SBC and R&D, and we can go into that if you want. Our portfolio basically hit a market multiple during the yen carry trade unwind. And after these last few weeks, we're getting close there again. Relative to the S&P, our portfolios really are at the low point in terms of that valuation metric throughout all of our history. So the valuation headwind is gone. I think what's shaking the market up right now is a recession. Now, we have been saying since the Fed jacked rates up so quickly that we've been in a rolling recession for the last 3 years. And the housing market certainly agrees with that. Autos, punk. Small businesses have been decimated. They couldn't get credit for a time there. Their net income is down 30% over the last three-ish years. So one sector after another gave way with small and medium business. Really, that's the backbone of employment, right? The last shoe to drop is consumer. Walmart just telegraphed, we're beginning to lose the consumer. And Walmart had been saying high-end had been a source of their incremental surprises to the upside. Target and Best Buy today. So I think we're at the last leg. It is the consumer. And why is this happening? I think the velocity of money is slowing down dramatically. And in fact, if you look at sequentially, it dropped in the fourth quarter. And it looks like it'll drop again. What does that mean? It means people are holding on to their money. Why? Well, I'm going to say, if you include federal, state, and local government and quasi-government in the healthcare and education space, we're probably looking at 30% of the people out there saying, I don't know if my job is safe.
Right.
And then you've got another layer of people out there in the higher income end of the spectrum saying, wait a minute, AI can do a lot of my job. What's going on here? And you see that with the coding fall off. So you've got uncertainty right now. But what is this going to do? It's going to give President Trump's administration and Chairman Powell all kinds of degrees of freedom if we do have negative GDP growth. We're already seeing long rates coming down. What's that telling us? Yep, real activity is coming down, but I think the shocker going forward, consider the source, I've been saying this for a while, is that inflation is going to surprise shockingly on the low side of expectations.
Kathy Wood, thank you so much for joining Odd Lots at Bloomberg Invest.
Thank you. Thank you very much for inviting me. Thank you, Joe. Thank you. Thank you so much. Thank you. Yes, thank you.
Thank you. Thank you, thank you, thank you. Thank you, Kathy. Thank you so much, Tracy, Joe, Kathy. Be sure to subscribe to Odd Lots on all of your platforms. I listen to it all the time as I'm on my way into work, and very happy every time I do. And that's it for this stage today. Thank you all so much for being such a great audience, and thank you to our speakers and our moderators so far. I'm grateful for all of you. Stay with me for just 2 minutes, a couple of announcements. I would like to thank our title sponsor, Invesco QQQ, as well as our presenting sponsor, MassMutual, and our supporting sponsor, TIAA. We'd love for you to stick around. We have networking and refreshment downstairs, so head out these doors, spend some time with us. I could use a glass of wine myself. Later this evening, if you are registered to attend, this one is a really fun one. Alex Rodriguez and Jason Kelly will be interviewing Ariel Investments' Melody Hobson in a live recording of their podcast, The Deal. There might be a few seats left to attend that, so if you're interested, talk to our staff if you'd like to join. And Invest isn't over yet. We have an amazing day of programming for you tomorrow. Excited to bring you all of that. Doors open at 8 a.m., starting at 8:45 a.m., the Innovation Stage, proudly sponsored by Invesco QQQ. We're going to kick off with some great conversations on all the private capital floating in AI, longevity and life in portfolios. A breakfast proudly sponsored by MassMutual starts at 8:45 in Hub 1, and our invite-only CFO roundtable begins at 8 a.m. And we start back on this stage again at 10 a.m. sharp with Carlyle co-founder and Bloomberg host David Rubenstein and former Treasury Secretary Stephen Mnuchin. We'll have timely conversations as well with the CEOs of TIAA, KKR, and Brookfield. Thank you all again. See you back here tomorrow.